In January 2020, two neighbors in suburban Denver made the same decision for the same reason. They both bought gold. Greg was 57, 30 years as a mechanical engineer at Lockheed Martin, $920,000 in his savings. He had watched it drop 40% in 2008 and swore he would never go through that again. So when COVID fears started building and gold was climbing, Greg moved $185,000, roughly 20% of his retirement savings, into a gold ETF. He bought at $1,780 per ounce in June 2020. Gold was making headlines. His brother-in-law had bought. Two guys at work had bought. CNBC was running segments about it every day. It felt like the obvious move. His neighbor Dan was 61, retired early from a career in insurance. Dan had also bought gold, but Dan had bought in March 2019, 14 months earlier, when gold was at $1,290 per ounce, when nobody was talking about it, when his own financial advisor told him it was unnecessary. By August 2020, gold hit $2,075. Greg felt like a genius. He was up 16% in 2 months. Then it started to slide. By March 2021, gold was at $1,680. Greg was underwater. He held on. Everyone said gold was going higher. Inflation was coming. The dollar was dying. All the reasons still made sense. By September 2022, gold hit $1,620. Greg was now down $18,500 on a position he had bought specifically to protect himself. He had moved money out of stocks that had recovered and were hitting new highs and put it into gold that was now worth less than he paid. Dan, meanwhile, had sold half his position at $2,000 in July 2020. He took profits, redeployed into farmland REITs and dividend stocks. His remaining gold position was still up 55% from his entry. He was sleeping fine. Same asset, same neighborhood, same reason for buying. Greg was down $18,500 and sick to his stomach. Dan had locked in over $40,000 in profits and redeployed into income-producing assets. The difference was not that Greg was stupid. Greg was an engineer. He analyzed everything. He read the research. He understood the thesis. He was right about every single thing. Inflation was coming. The dollar was losing purchasing power. Economic instability was real. He was right about everything. And he still lost money. Because Greg made the same mistake that gold buyers have been making for over 150 years. A mistake so predictable, so well documented, that once you see the pattern, you cannot believe people keep falling for it. Greg had been given the popular version of the gold playbook, the version that tells you what to buy, not when. My name is Ben, and I probably spend far too many hours digging through historical financial records, central bank data, and over a century and a half of gold price history, studying the patterns that show up every time investors stampede into gold during a crisis. If you're holding gold right now, considering buying it, or you jumped in during the last surge and are now sitting on a loss wondering what happened, stick with me. We're not talking about whether gold is good or bad. That is the wrong question. We're talking about the 7 specific mistakes that gold buyers repeat during every single crisis going back to 1869, exposed with exact dates, exact prices, and exact outcomes. Mistakes that have cost people not just money, but decades of their financial lives. If this matters to you, hit subscribe right now. I'm going to keep exposing these historical patterns that the gold industry and mainstream financial media never discuss honestly. Hit that like button. It tells the algorithm to push this to more people who need to see it before they make the same mistake. Here's the thing about gold that almost every expert gets wrong. They talk about gold like it is a simple trade. Economy bad, buy gold, profit. But that is not what the data shows, not even close. I call it the gold trap cycle, and it has repeated with mechanical precision for over 150 years. Gold does not just go up during crises. It follows a specific four-phase pattern every single time. Phase 1 is the early warning. Smart money, central banks, institutional investors, they start buying 12 to 24 months before a crisis becomes obvious. Gold rises steadily. Nobody's paying attention. Headlines are still optimistic. This is when gold is cheap and boring, and nobody on television is talking about it. Phase 2 is the panic spike. The crisis hits. Headlines turn apocalyptic. Gold explodes. 50%, 100%, sometimes 300% in months. This is when your brother-in-law starts talking about gold. This is when coin shops have lines out the door. This is when it feels obvious. Phase 3 is the trap. Gold stays elevated. It feels safe. More people pile in. Everyone congratulates themselves for being smart. Phase 4 is the slow bleed. Quietly, gold begins a multi-year decline. Not a dramatic crash, a slow, grinding, hope-destroying decline that can last 10, 20, even 28 years. The mistake that destroys people is this. Most retail buyers enter during Phase 2 or Phase 3. They buy when it feels safest, which is precisely when it is most dangerous. Let me prove this with 150 years of evidence. The first mistake is the most common. Buying gold after it has already risen 50%, 100%, or 300%. Gold only makes headlines after it has spiked. By the time your neighbor mentions it, smart money has been positioned for months, sometimes years. You are not getting in early. You are providing liquidity for the people who want to get out. Look at 1980. In January 1979, gold was at $223 per ounce. By January 1980, 1 year later, it hit $850. That's a 280% gain in 12 months. When did most retail buyers enter? During that final 12 months, when it was obviously going higher.
Gold buyers at $850 waited 28 years just to see that number again. Not to profit, not to beat inflation, just to break even. 28 years. Same pattern in 2011. Gold peaked at $1,895 after a massive run. Everyone was buying. Hedge funds, pension funds, your coworker. By December 2015, gold was at $1,050, a 45% crash. Those buyers waited 9 years to break even, while the S&P 500 tripled. And this is not new. In 1869, Black Friday, gold spiked from $143 to $162 in a single morning during a speculation mania. Ordinary Americans rushed to buy at the top. 15 minutes later, gold crashed to $133, an 18% collapse in 15 minutes. Families were ruined before lunch. 2011, different decades, different crises, identical mistake. Now here is where it gets darker. The second mistake is psychological, and it is the reason smart people keep falling for this. Gold feels safest to buy precisely when it is most dangerous, because safety is a consensus feeling. When everyone agrees gold is necessary, it is already priced in. Think about what feeling safe actually means. It means headlines everywhere agree gold is going up. Your friends are talking about it. Experts on television are recommending it. It feels obvious. The documented warning signs from 1980 and 2011 are almost comically identical. Lines outside coin shops, television personalities selling gold on air, cash for gold shops appearing on every corner, magazine covers featuring gold bars, your uncle who has never invested in anything asking how to buy gold. When any of these appear, you are in Phase 2 or Phase 3. You are late. The people who actually made money did the exact opposite. They bought when gold felt unnecessary, when headlines said gold is a relic, when it was boring. 1999, gold at $250 per ounce, mocked as outdated. The next 10 years, it went up 650%. 2000, gold at $1,050, gold investors humiliated. The next 5 years, it went up 85%. Buy when it is boring, not when it is exciting. That is the pattern, and almost nobody follows it. But it gets worse. The third mistake destroys people who think they're too smart to get caught, being right about everything and still losing. In 1933, American gold holders could see what was coming. Banks were failing. The economy was collapsing. They were hoarding gold. They were correct about every single thing. Then came April 5, 1933, Executive Order 6102. President Roosevelt made it illegal for American citizens to own more than $100 in gold. Penalty, $10,000 fine, 10 years in prison. Americans were ordered to surrender their gold to the Federal Reserve at $20.67 per ounce. Then, 9 months later, the government revalued gold to $35 per ounce. $20.67 to $35, a 69% increase for the government. The citizens who did the right thing surrendered their gold at $20.67. The government immediately marked it up and kept the profit. They were right about the crisis, right about the banks, right about the dollar, and they still got destroyed. Same thing in 1980. Gold buyers were right about inflation. It was running at 14%. They were right about the dollar losing value. They were right about economic chaos. They were wrong about timing. 28 years to break even. Here's the lesson nobody wants to hear. Correct analysis does not equal correct trade. You can be right about the macro picture and still lose money, because timing and execution matter as much as thesis. Greg was right about inflation. He was right about the dollar. He still lost $18,500. The fourth mistake catches people because they expect the wrong kind of danger. They expect a fast crash. What they get is a slow death. Here's what people imagine. If gold goes down, it will crash suddenly. They will see it coming. They will have time to exit. Here's what actually happens. Gold does not crash like stocks. It bleeds, slowly, for years, sometimes decades. January 1980, $850. March 1980, $490, down 42% in 2 months. 1982, $296. 1985, $285. 1999, $252. 2001, still around $260. 21 years of slow, grinding decline. And here's the psychological trap that makes this deadly. A small rally happens and you think it's coming back. A new low hits and you tell yourself you will wait until you break even. Another rally and you convince yourself this is the bottom. Another low and you think you can't sell now because you are down too much. The trade becomes a long-term hold, not because you planned it that way, but because admitting the mistake is too painful. Same pattern after 2011. September 2011, $1,895. December 2013, $1,192, down 37%. December 2015, $1,050, down 45%. July 2020, finally back to $1,895. 9 years. Holding an asset that generates zero income, watching stocks triple. The slow bleed doesn't feel like losing, it feels like waiting. And people can wait for decades without ever realizing they made a mistake. The fifth mistake is the most disturbing one, not having gold when you finally need it because it's already gone. August 1914, first day of World War I. The German government launches a campaign. The slogan, Gold gab ich für Eisen. I gave gold for the defense of the fatherland. Citizens are encouraged to donate their gold, jewelry, watches, wedding rings. In exchange, they receive iron replacements stamped with patriotic slogans. Millions of ordinary Germans complied. They were patriotic. They trusted their institutions. Fast forward 9 years to 2023. Bread costs 200 billion marks. The mark loses 30% of its value while you stand in line. A newspaper costs 50,000 marks at breakfast and 100,000 marks by evening. And the gold, gone. Not seized at gunpoint during the crisis, donated voluntarily 9 years earlier before anyone understood there would be a crisis. Governments do not need to confiscate gold during a crisis. They can remove it from ordinary hands before the crisis through patriotic campaigns, tax penalties, or reporting requirements. By the time you realize you need gold, it may already be too late to get it. The sixth mistake is treating gold as a complete solution, holding gold alone without a conversion plan or complementary assets. Here is what most people do not understand. Gold is a store of value, not a medium of exchange. In an actual crisis, you do not hand a gold coin to a baker. The documented record from Weimar Germany shows what people actually used to survive. Foreign currency, dollars, Swiss francs, British pounds. The dollar became the closest thing to a universal survival currency. Private barter. One woman traded her late husband's gold watch chain for 4 bags of potatoes. Direct exchange, no receipt, 2 people agreeing on value, and speed. One man described his father's payday ritual: receive salary, immediately buy transit pass, get haircuts, buy dry goods, convert whatever remains before prices change again, never hold paper overnight. Gold holders did not spend gold directly. They converted gold to dollars at unofficial exchange points, then transacted in dollars. Or they bartered gold for essentials, a coin for a month's rent, jewelry for farmland access. Gold is only as useful as your ability to convert it. If you cannot answer 3 questions, where will you convert gold to usable currency, who will you trade with, and what is your network of trusted counterparties, then you do not have a plan, you just have metal in a safe. The 7th mistake is the one that contains all the others, not knowing where you are in the cycle. Let me show you the 4-phase pattern across 150 years. 1869, Black Friday. Phase 2 buyers rushed in during the spike, destroyed in 15 minutes. 1934, confiscation. Phase 2 and 3 holders surrendered gold at $20.67. Government revalued to $35. 1980, peak. Phase 2 and 3 buyers bought at $850, 28 years to break even, while stocks tripled. The pattern is identical every single time. The details change: inflation, deflation, war, banking crisis, but the 4 phases repeat. Now here is why this matters to you specifically. If you are sitting on a 401k, an IRA, a pension, or any retirement savings, and you're thinking about moving a significant chunk into gold because the economy feels unstable, you need to ask yourself one question: which phase are we in right now? If gold is making headlines, if non-investors are talking about it, if it feels necessary and obvious, you are in phase 2 or phase 3, and that is the worst possible time to buy. If you already own gold and you bought during a run-up, you need to look honestly at where you entered. If you bought after a 50% or greater rise from the recent low, you are statistically in the danger zone. Every major gold trap in history started with someone who was right about the thesis and wrong about the timing. And if you have a significant portion of your retirement in gold with no conversion plan, no complementary assets, and no exit strategy, you do not have protection. You have an expensive feeling of security. So, what do we actually do with this information? Look, the first thing we need to talk about is sizing. Gold should be insurance, not your portfolio. Most people who get destroyed by gold made it too large a position. They went 20, 30, 40% into gold because they were scared. And then, when gold declined, they could not absorb the loss. If I were in your position, I would cap gold at 5 to 10% of total portfolio value. That's enough to benefit from a crisis spike without being destroyed by a multi-year decline. Think of it the way you think about homeowners insurance. You do not spend 40% of your income on insurance premiums. You pay enough to be protected, and you live your life. The smart money, the institutional investors, the family offices that have survived every crisis for generations, they typically hold 3 to 7% in gold. Not because they don't believe in it, because they understand that gold is one tool in a toolbox, not the entire toolbox.
Now, here is where it gets interesting. The assets that actually complement gold during a crisis are the ones that do what gold cannot. They generate income. Farmland REITs like Gladstone Land, ticker LAND, or Farmland Partners, ticker FPI, give you exposure to an asset that has only had 3 negative return years in the last 50, compared to gold's 15. Farmland returned 11.5% annually over 50 years, and it pays dividends while you wait. During 2008, farmland went up 6% while gold was volatile and stocks crashed 57%. Consumer staples like Procter & Gamble, Coca-Cola, Walmart, and Costco, or the XLP ETF, give you companies that people buy from regardless of economic conditions. These stocks pay dividends, have pricing power, and declined only 28% during 2008 compared to the S&P's 57% drop. Long-term treasuries through TLT give you your deflation hedge. In November 2008, long-term treasuries gained nearly 15% in a single month. The point is this: gold protects purchasing power. Income-producing assets protect your lifestyle. You need both. And the people who come through crises in the best shape have a balance, not a bet on one asset. But here's the thing. You need to be watching for signals that tell you when gold is entering each phase, so you know when to accumulate and when to back off. The first signal is the headlines test. If you're seeing gold mentioned daily on financial news, if coin shop ads are appearing everywhere, if non-investors in your life are asking about gold, you are in phase 2 or phase 3. Do not add to positions. At any rate, consider taking some profits. The second signal is the 50% rule. If gold is up 50% or more from its most recent significant low, the risk-reward has shifted dramatically against new buyers. This single rule would have kept you out of the 1980 trap, the 2011 trap, and every other major gold disaster in 150 years of data. When gold is up that much, the easy money has been made. What remains is risk.
The third signal is the boring test. When gold is being mocked, when gold bugs are humiliated, when financial media calls it a relic, when it has been declining for years and nobody wants it. That is phase 4. That is when the next cycle's smart money is quietly accumulating. Gold at $250 in 1999. Gold at $1,050 in 2015. Those were the entries that made fortunes, not the exciting ones, the boring ones. Now, I'm not saying you need to restructure your entire portfolio tomorrow, but what I am saying is you need a framework, because gold without a framework is just an expensive emotional reaction, and emotional reactions during crises have a 150-year track record of destroying wealth. Let me bring this back to where we started. Greg made every mistake in the book. He bought after gold was already up significantly. He bought when it felt safe. He was right about the macro picture and wrong about the timing. He had no exit strategy, he had no complementary assets, and he had no framework for understanding where he was in the cycle. Dan understood the cycle. He bought during phase 4 when gold was boring and unloved. He sized the position appropriately. He took profits when gold entered phase 2, and he redeployed into income-producing assets that would protect him regardless of what gold did next. Same neighborhood, same asset, same reason for buying, completely different outcomes, because one had the full playbook and the other had the popular version. The 7 mistakes I just showed you are not ancient history. They are happening right now. Somewhere today, someone is buying gold for the first time because it feels obvious, because the headlines say so, because their brother-in-law just bought. They are entering in phase 2 or phase 3, and they do not know it. Somewhere today, someone is sitting on a gold position they bought near a peak, watching it decline, telling themselves it will come back. It might, in 9 years or 28. And somewhere today, someone with 150 years of historical evidence in front of them is buying gold quietly during phase 4
When nobody is talking about it, sizing it at 5 to 10%, complementing it with income-producing assets, and building a conversion plan for when they actually need it. The question is which one of those people you are going to be. If this changed how you think about gold, if you finally see the cycle instead of just the asset, do me a favor. Share this with someone who needs to hear it before they make the same mistake that gold buyers have been making since 1869. A spouse, a friend, someone who is about to move a chunk of their retirement into gold because it feels safe. We do not talk about this honestly. The gold industry does not want you to know about Phase 4. They make money selling during Phase 2 when everyone is panicking. Financial media does not cover the 28-year waits or the slow bleeds. They cover the spikes because spikes get clicks. Hit subscribe because next week I'm breaking down what central banks are doing with gold right now behind the scenes and what it signals about the next 12 months. This is Ban. Stay sharp out there.